What if I tell you the real Achilles heel of the world economy is not this COVID-19 pandemic, but the global dollar system, and it's doomed to fail? What if I tell you Bitcoin might be perfectly designed to play the role of a new world reserved currency and replace the dollar system? In this video, we will go through the brief history of money, learn from the past, and discover the answer to one of the most asked questions. Will Bitcoin be the gold standard 2.0 for our future? Whether it's the coins in your pocket or the internationally accepted credit card in your wallet, money makes the world go round. Without it, we'd stuck with the system our ancient ancestors used, trading chairs for pigs and candles for money. The trick of designing money is finding something that everyone can accept and trust. In the 19th century, it was paper money backed by gold. The idea was simple, yet effective. After all, few things are better suited to retaining value than precious metal. The result was an age of unprecedented growth and prosperity. However, things started to go wrong in the early 20th century, when governments abandoned what we knew as the gold standard, and simply began printing money. The result? A century of boom and bust economy and increasing debt. We don't need to return to the gold standard to get back the sound finances we want, because there is a new kid on the block, and it's perfectly suited to our digital age, Bitcoin. Before we get into Bitcoin, let's go back in time and study how exactly we got here. How does an economy work without money? Simple. You trade stuff, call it barter or direct exchange. You could trade 2 pigs for 1 cow or for a haircut. It all depends on what you have and what your neighbor needs. But here is the problem. Sometimes those things don't align. What if your hairstylist neighbor doesn't want your 2 pigs? Or someone wants your 2 pigs but doesn't have anything you need? Well, that's where money comes in. Because everyone wants it, you can use it for any transaction, and that's known as indirect exchange. The early money wasn't anything like the stuff you can keep in your wallet today. It can vary from stones, cowrie shells, barley, or even salts. In fact, do you know that the word salary originally comes from the Latin word sal? It literally means salt. Because in ancient Rome, people got paid with salt, which was an expensive but essential commodity. The first money resembling the change in your pocket today was a product of a revolutionary technology, metallurgy, the craft of smelting metals. This technology made it possible to create highly salable coins that were both small and light enough to be carried far and wide. One metal stood out from the crowd: gold. Why? Because it all has 3 unique features. First, it's virtually impossible to destroy gold and can't be synthesized using other materials. Second, the amount of gold is scarce and limited. Third, the more gold people mine, the more difficult it is to mine gold. The supply of gold grows slowly and predictably. Combine these 3 traits, ancient people believe they have a material that's incredibly effective as a means of exchange and store of value. Gold may have been around forever, but the love affair between paper money and gold only really blossomed in the 18th, 19th, and 20th centuries. These centuries were shaped by rapid advances in communications and transportation. Technologies like telegraph and trains make it easier than ever for both people and goods to get from point A to point B. That in turn increased the needs of using non-physical forms of payment, like checks, paper receipts, and bills. But how do you convince merchants and consumers that a piece of paper you're using to buy or sell is worth anything? The answer: governments worldwide came up with an idea, and it was to issue paper money backed by precious metals. In Europe, the most commonly used metal was gold. In fact, the UK was the first nation to introduce the gold standard in 1717. By the 1900s, around 50 countries had adopted the gold standard. Gold became increasingly valuable as more and more nations issued paper currency backed by gold reserves. But the gold standard had one major flaw. The gold had to be stored in a small number of bank vaults. This facilitated the exchange of paper money for gold. But it also created a highly centralized system in which governments controlled the value of paper money. It means if the government wanted to, they could always increase the supply of money without increasing the corresponding amount of gold. That is why we see that in 1914. Nearly every major European nation decided to make the most out of it. World War had simply broken out and they needed cash to fund the war. Rather than raising taxes, they simply printed new money. But it wasn't backed by gold. Within a couple of weeks, the countries fighting the First World War had suspended the convertibility of paper money into gold. The gold standard in Europe had been abandoned. And this major regime shift has been going on to play the major role in shaping Europe's economic decline even until today. When the First World War came to an end in 1918, the European countries that had been involved in the conflict needed to deal with revaluing their currencies. The obvious solution was to return to the gold standard, but a fair re-evaluation compared to gold would have been an unpopular admission of how little currencies were now worth. So, the government chose to introduce a new player, fiat money, the money which backed by the government's goodwill rather than gold. The adoption of fiat money led to an age of deeper chaos in Europe. By 1944, the end of the Second World War was in sight, and the obvious winner of the war, the United States, had quietly begun planning the post-war New World Order, Bretton Woods system. The basic idea was that the world currencies would be tied to the US dollar at a fixed exchange rate. The dollar would in turn be tied to the value of gold as a fixed rate. The newly created IMF, better known as International Monetary Fund, would be in charge of policing these exchange rates. In theory, Bretton Woods should work like the gold standard, and money supply should be strictly backed by how much gold the central banks have. But in practice, it didn't quite work like that. The pretense of the Bretton Woods system was dropped, and gold was completely abandoned as a standard in 1971. US dollar has officially become the world's reserve currency, and its pure fiat currency, the value of it, would be freely determined by the government. What is a sound money? Sound money is the money that is not prone to sudden appreciation or depreciation in purchasing power over the long term. It's often seen as the stable money, the money that is strictly backed by something effective as a store of value. For example, gold. First, sound money is a great way of encouraging people to save and invest, the perfect recipe for sustainable and long-term growth. Why? Because humans generally have a natural high time preference. We prefer instant gratification over delayed future gratification. Sound money nudges us to think more about the future. So if we reasonably expect our money's value to increase over time, like sound money, it would make sense to take a look at what we can do now to maximize our future income. And this is what investment is all about. Postponing your gratification today to achieve a greater rewards for tomorrow. Investment essentially leads to greater productivity. People invest money into producing capital goods, machines, equipment that can be used to create more goods and more revenue streams in the future. On the opposite side of sound money is unsound money, or the easy money. The problem with unsound money is that it distorts capital accumulation. In a free market, price reflects the full information of how much people would like to pay for a certain thing at a certain time. However, with government intervention, injecting unsound easy money, it means that the prices no longer reflect the market movements. Eventually, the capital market will not be functioning. This is why some economists warned people back in 2008 that too big to fail would be the beginning of the end of capitalism. And we are seeing the similar situation in 2020 as well. The government has printed trillions of dollars out of thin air to bail out those big corporations, which spent most of their revenues on share buybacks instead of investing for the future. Essentially, too much unsound easy money will cause two major issues in our economy: recessions and the endless accumulation of debt. Let's start with recessions. Government interference in the market takes form of central planning. But here is the problem. In a free market, there is no single person, agency, or department that is ever able to analyze every single information necessary to understand constantly changing web of choices, costs, and resources that define an economy. And if you don't make decisions based on a full picture, you're bound to make bad decisions. And this is precisely what governments do when they manipulate the money supply. Their interventions distort markets, especially capital market, creating a boom and bust cycle. During the upcycle, artificially inflated money tricks investors into thinking they can buy more capital than they can afford. This soon becomes a bubble in the market and makes financial assets overvalued. When the bubble pops, the economy goes into recession. We can't talk about recession without talking about debt. To see how unsound easy money leads economies to become deeply indebted, we should go back to the Great Depression in the 1930s. During that era, governments believe recessions happen when the total spending is too low in an economy, and the best way to respond to recessions is to increase spending. How did they do that? Well, they could lower taxes, but it has very limited power to push people to spend more during a recession. They could lower the interest rate to make the money cheaper to borrow. But what if the interest rate is already zero? Then the only other option for the government is to increase the money supply by printing helicopter money out of thin air. Printing money might temporarily solve the spending problem and boost the economy. But this has serious secondary effects on the way people see money, spend money, and invest money. All those unsound easy money that the government prints circulating around the economy tends to push people into focusing on the present because the entire industry pushes people to spend the money from their future and buy the things they cannot afford today. Saving becomes less attractive because the purchasing power of fiat money will only become weaker and weaker when the governments print more and more of it. Soon enough, people are enslaved by being deeply in debt. The overall effect of having too much unsound easy money is causing endless crises. But there is an alternative. We need to return to an economy with sound money, backed by a new gold standard. The new technology of Bitcoin might help us just do that. So, how exactly can the world's first digital currency help put economies on the road to recovery, stability, and growth? Think back to the gold standard. Markets choose gold to store value for two reasons. First, it's scarce, and second, it's predictable, meaning that there is little risk of the supply increasing enough to significantly deflate its value. Bitcoin has similar traits. In fact, its supply is literally fixed at 21 million. The way Bitcoins are created also leads to stability, since the supply of the currency grows at a constantly diminishing rate. The number of Bitcoins issued is halved every 4 years. And the algorithmic problems become more and more difficult to solve as the number of computers working on them rises, guaranteeing a steady and reliable supply in much the same way as increasing difficulty of mining gold makes the supply of gold steady and reliable. Bitcoin will continue being issued in ever smaller quantities until 2140, after which no more coins will be released. That makes Bitcoin unique. They are only good that is defined by absolute scarcity in the world. No amount of time or resources can create more coins than the algorithmically programmed supply allows. Therefore, Bitcoin can never be devalued by manipulating the supply, making it a perfect store of value. Fortunately, Bitcoin is also incredibly secure because of the Bitcoin ledger, which uses an innovative technology called blockchain. Blockchain technology makes the Bitcoin network entirely self-sustaining. There is no need for a third party as the central authority to oversee the transactions. Therefore, there is a very good reason for central banks to be backed by Bitcoin, issuing their own digital cash currency, and they are redeemable for Bitcoin. Bitcoin itself doesn't need to scale to handle every single transaction in the world. The key function of Bitcoin can be adopted as a worldwide reserve currency and only transact between each central bank. Many economists truly believe this will be the ultimate fate of Bitcoin, to be the high-powered money that serves as reserve currency for different central banks around the world to issue their own digital cash backed by Bitcoin. Most Bitcoin transactions will occur between each central bank. To settle net transfers, individuals will use digital cash to handle their daily transactions. This is what many economists call the Bitcoin standard. Of course, Bitcoin is still in the incubation stage. There are many developments that need to be done. As any other new technologies, Bitcoin will have to overcome many challenging problems to truly become the decentralized alternative to central banking. But one thing for sure, the current fiat money system is no longer trusted by people, and the capital market we used to know is no longer functioning. Our economy is desperately searching for the next gold standard to save our future. And for now, there is no better answer than Bitcoin.